Hier ist die neue Folge der Ökonomie-Videos.
Ever stared at a stock chart with all those jagged lines and crazy peaks and just felt totally lost? Yeah, you're definitely not alone. Today, we're going to pull back the curtain on how to make sense of it all. This is your beginner's guide to what's called technical analysis, basically a toolkit for trying to find some order in all that chaos. Right from the start, every investor gets hit with two completely opposite pieces of advice. There's an old German saying, hin und her macht die Taschen leer, which means jumping in and out of trades just empties your pockets. But then in the other ear, you hear the classic wisdom, just buy and hold. So which one is it? Are we supposed to be active or just sit on our hands? And that really brings us to the million-dollar question, doesn't it? How do you actually know when to pull the trigger? What's the signal that tells you, okay, now's the time to buy? Or maybe even more important, now's the time to get out? Well, technical analysis is one very popular and, yes, very controversial way people try to answer exactly that. Okay, we have to get the big counter-argument on the table right away. A huge part of modern finance theory basically says you can't predict the future by looking at the past. The idea is that any public information, news, earnings, you name it, is already baked into the stock's price. So trying to analyze a chart can feel a little like trying to drive a car by only looking in the rearview mirror. So you're probably thinking, if it's so debated, why are we even talking about it? Well, for one massive reason. Because so many people believe in it and use it, their actions can actually move the market. You see, when millions of traders are all staring at the same charts and seeing the same patterns, their buying and selling can become a kind of self-fulfilling prophecy. It's especially popular for short-term trading, where timing is, well, everything. All right, with that in mind, let's open up the toolkit. The very first step is just learning the basic language of the charts themselves. First off, forget those simple line graphs from high school math. Most traders use what's called a candlestick chart. And get this, the idea actually came from Japanese rice merchants centuries ago. The genius of it is that each one of these little candles packs a ton of information into one simple shape, telling you the whole story of a trading day at a single glance. And reading them is really straightforward. If a candle is green, it means the price closed higher than where it started. A good day. If it's red, it closed lower. That thick part, the body, shows you the range between the opening and closing price. And those thin little lines sticking out the top and bottom, those are the wicks, and they show you the absolute highest and lowest price the stock hit that day. Simple as that. So once you can read what one candle is telling you, the next step is to zoom out and connect them. This tool is all about drawing a couple of simple lines to uncover some pretty powerful patterns. Let's use a real example to make this concrete. Here's the chart for the company Alliance in early 2025. An analyst looking at this isn't just seeing random noise. They're asking questions like, are the peaks getting higher? Are the bottoms also getting higher? They're basically on the hunt for a trend. Now watch this. By simply drawing a line to connect the high points and another line to connect the low points, boom, a clear upward channel just emerges from the noise. In trader speak, that bottom line is called support. It's like a floor where buyers keep stepping in. And the top line is resistance, a ceiling where sellers tend to show up and take profits. And right away, this pattern suggests a strategy. If you believe the stock is going to respect this channel and keep trading inside of it, the playbook seems pretty clear. You might look to buy when the price is near that bottom support line, and then maybe sell when it gets up near the resistance line at the top. But, and this is a huge but, charts don't exist in a vacuum. The real world has a nasty habit of just crashing the party. And on April 2nd, a huge news story breaks. The US president announces new tariffs. That's the kind of thing that can send a shockwave through the entire global market, and it doesn't really care about the neat little lines you drew on your chart. And that's exactly what we see here. The price of Alliance just slices right through that support line we identified. The real-world news was just way more powerful than the pattern. It's such a critical lesson. Chart analysis is a tool, for sure, but it is not a crystal ball. It can't predict a surprise headline. So, besides just drawing lines by hand, analysts use automated tools. And one of the most fundamental ones uses some pretty simple math to smooth out all the wild swings. It's called the moving average, and its whole job is to cut through the daily market noise. It takes all those jagged price movements and creates a single, much smoother line that can help you see the real underlying trend more clearly. And the math behind it is actually dead simple. If you want a 3-day moving average, you just add up the closing prices of the last 3 days and divide by 3. Then on the next day, you drop the oldest price, add the newest one, and calculate it again. See? It's moving because the group of numbers you're averaging is always rolling forward. Now, the key decision is which time frame you want to use. You can think of it like this. A long-term 200-day average is like a giant cruise ship. It turns very slowly and it shows you the massive underlying current of the market. But a short-term 38-day average, that's more like a speedboat. It reacts fast to recent price changes and is used for generating much quicker trading signals. So what's the actual signal here? Well, it's all about something called the crossover. When the actual stock price punches up and crosses above its moving average line, that's widely seen as a buy signal. And when it dips down and crosses below that line, that's your sell signal. Okay, let's jump back to our alliance chart during that tariff news. The slow 200-day cruise ship average, it barely even blinked, gave off 0 signals. But the quick 38-day speedboat average, it flashed a clear sell signal as the price fell, and then it flashed a buy signal when it started to recover. A trader who was watching the right indicator could have potentially navigated that volatility. All right, we're at our final set of tools. These are called indicators. You can think of them as even more complex mathematical formulas that try to give us more nuanced signals about the market's momentum and its overall health. Now, there are literally hundreds of these things, so don't get overwhelmed. They mostly fall into 3 big categories. Some, like Bollinger Bands, are designed to help you follow a trend. Others, called oscillators, try to measure momentum. And volume indicators, well, they track how much buying and selling is happening behind a price move. Let's just zoom in on one of the most famous oscillators, the RSI, or Relative Strength Index. It measures momentum on a simple scale from 0 to 100. If the RSI gets above 70, traders say the stock is overbought, the idea being it's gone up too far, too fast, and might be due for a fall. And if it drops below 30, it's oversold and could be ready for a bounce. It's basically a gut check on the market's mood. So after all of this, what's the bottom line? The most important takeaway is that technical analysis is not a crystal ball. No line, no average, no indicator is going to predict the future with 100% accuracy. It's much healthier to think of it as a lens, a way to interpret market psychology and momentum. It's a fantastic toolkit for finding ideas, but it's always best when you use it with other real-world information. Which leaves us with one last really fascinating question to chew on. Are these patterns we see in the market real things, reflecting the predictable psychology of human beings in a crowd? Or are we just wired to see patterns everywhere, to find meaningful shapes in what is ultimately just random noise, kind of like seeing animals in the clouds? That right there is a debate that still keeps the market interesting.